What's up, guys? Welcome back to the channel. Thanks for tuning in. Today in this video, guys, we're going to talk about Tokemak and how it is, well, the black hole for all liquidity. Guys, this is a game changer. Like, not only do you have just something like DEX aggregators, this one flips it on its head. It's actually owning the assets. So before, with previous protocols, like say for example farming coins, they're going to have to launch their token, give liquidity mining incentives, etc. But what's the problem with that? Well, you guys are on this channel, you guys understand the farming rules. Farm and dump, farm and dump, farm and dump. Unless you're like super bullish on it, then farm, dump, and maybe hold a little bit just for fun. But the point is like this is solving that problem. Instead of people constantly having that dump pressure on the coin, this is where TOKE comes into play. It is actually bringing liquidity where it is needed most. So this is basically a liquidity director, but it is going to be the black hole for liquidity, in my opinion. Of course, this is not financial advice. I'm going to explain it today with the whiteboard, not the white paper, but the whiteboard. You know, this guy. We can go ahead and jump into it. I'll go ahead and talk about a couple things about the protocol as well. I'll go ahead and explain it, but let me go ahead and zoom in so you guys can see what's up. Wow, I just got really big. So guys, here's our whiteboard. We're going to do the best we can because them jerseys are in the way. So this is typically how TOKE works. TOKE is basically the token that is driving all of this. If you don't know what Tokemak is, it's basically like the nuclear reactors, whatever. Just go on Google and type in TOKE with an E or Tokemak with an E, and you'll be able to pull up like what it looks like. So this is typically where it starts. You have a protocol that wants to launch their coin. But typically when you launch a coin, you need to either give liquidity mining incentives. So you need to say, hey, we're giving like 2,000% APR if you provide liquidity with our coin. The problem with that is the people getting the coin are getting it at a lower price because they're incentivized for getting lower or higher APRs and getting the coin at a lower price, But the early users, aka part of the Ponzi, like the top of the pyramid, they're going to be getting the most rewards. So what's going to happen when they get all those rewards is they're incentivized to dump them because they're going to make nuts and ham because they're getting them early, they're getting them at a lower price, and they're farming crazy rewards. So this is typically how the rewards are going to go. Say for example you have sushi. Hey, we want to give 1,000% APR. We're just calling it sushi because we're just calling it sushi. Man, that is in reverse, but I can't write backwards, so we'll make it happen. Just remember what I'm talking about. So you got sushi right there. Sushi's doing its thing. It's like, well, that would be so weird. What if your face was like opposite instead of like everything symmetric? Then it's like, I don't know. Just a thought. That would be really weird. But anyways, sushi, 1,000% APR. Say I get sushi at $1 and I LP with 1 ETH. I know it's a lot for one sushi, but anyways, sushi goes to $10. So now I have one sushi, well, not even one sushi, it'll be 0.1 sushi for about 10 ETH. This is after the price appreciates, but I'm getting 1,000% APR. So I'm basically getting nuts and ham. I got a big bag of sushi. So I'm just going to dump on y'all, all you farmers. And you guys see this in the charts all the time. It literally goes like this, and then it goes relief rally, and then it goes wham, and death. It's over. Game over. So this is where TOKE comes into play. It's like, bruh, you don't need to provide liquidity or you don't need to incentivize liquidity. Just do this. We got all the tokens. We got ETH, we got USDC, and we're paying people in TOKE. So we got a large supply. So we can take care of that for you. And we'll direct your liquidity. So if there's a lot of demand on Uniswap, we'll take care of that. If there's a lot of demand on SushiSwap, we'll take care of that. Don't worry. We're the black hole for liquidity. So what we do is we incentivize people who have ETH or USDC, whatever, and we pay them TOKE. So we say, hey, we'll pay you TOKE for your ETH. And same thing with USDC. We pay you TOKE for your USDC. So now you got a big pool of USDC, which is aka liquidity, money, let's do this, and ETH. And you got other projects who are like, we want some of that junk, but we don't want to get dumped on. What can you do for us? Oh, well, we'll direct your liquidity to both Uniswap, Uni, sushi. I mean, you name it. We'll send it wherever you need it. I mean, we'll take care of it for you. But in order for us to do this, you got to pay us TOKE. So remember, they're paying out TOKE. So now they're paying out TOKE. They're getting ETH and USDC. And then you got the projects who are like, look, we need to get some liquidity. We don't want our coin just being like massively dumped on. So can you help us, please? So here's what we'll do. You pay us TOKE. And then we'll have someone else, if they want to say, for example, they want to provide liquidity for sushi, some other person is going to get it off the market, they're going to provide the sushi, they're going to get TOKE, and you're paying in TOKE to take care of that. So they're paying the USDC, the project is paying the TOKE, so now you have the TOKE USDC pair, and it's going sushi, uni, wherever you need it. So this project is only having to pay out TOKE. They don't even have to release their coin. They literally are just paying out the TOKE. They don't have to incentivize the rewards, whatever. So they're giving TOKE, and the people over here are giving sushi. So instead of dumping it, they're actually giving it to the TOKE ecosystem, and they're providing liquidity at different places. So now, this is why it's important. So instead of renting the liquidity, they actually own it. So TOKE is owning this liquidity. So they're earning a portion of the fees off it. They aren't just being parasite farmers. Like, they aren't getting the rewards, pulling the liquidity, and just saying bye-bye. No, they're leaving the liquidity in there and bringing it to other pools. So this is why it's going to be the black hole for liquidity. Because eventually, over time, these LP tokens that they have in this pool, they're going to be earning rewards. So like, you know, that 0.3% swap fee, or like any of the incentive rewards that you get for depositing in a pool, etc., that's going to accumulate in here. So now all the rewards that are in here, they're going to be gaining more and more fees, but eventually there will be a point of singularity where it's like, oh, bro, you need help with liquidity? We got your back. We got money in here, just pay us some TOKE. So they're going to be bringing TOKE in here, paying TOKE in here, and then you're going to be providing liquidity elsewhere. I mean, guys, it's going to get to the point where it's singularity, and they even have dynamic rewards. If there's no demand for ETH and USDC, like no one's paying it, then you just up the TOKE rewards. If there's like way too much, then you just get rid of the TOKE rewards. So it keeps the token price from diluting. Now, what is the price of one TOKE? Well, TOKE is equal to 1 unit of liquidity. So similar to like Ohm is backed by 1 DAI, but it can have extra, TOKE is backed by 1 unit of liquidity plus the swap fees that it's earning. So over time, it's going to increase more and more in value. So eventually, let's go ahead and go to the website. I'm going to go ahead and shrink my face. Tiny. Look at me. But you guys see these APRs. They're incentivizing people for giving up their USDC, their ETH, and TOKE tokens. Now, the TOKE in this pool right here is basically staked TOKE. What these guys do, the TOKE is quote-unquote also a governance token. You can say, I want the USDC and ETH in this pool to go to Frax, or I want it to go to Alchemix, I want it to go to TCR, or Ohm, or Sushi. Now, why is this important? Well, in order for these protocols to get votes to be able to say, yeah, I want your money here because I vote on it, they have to get TOKE tokens. This is why I'm explaining to you the use case and the value of the token. So it's not only a utility coin, but it's also governance. So now you can vote on what does what and where it goes. So this is going to be the black hole for liquidity, and what's going to accrue in value from all the swap fees is the TOKE token. So you can also provide LP for Uni, Sushi. These APRs used to be higher, but as we get more and more asset TVL compared to the TOKE TVL, it's going to be, well, reaching the point of singularity, and there will be less rewards. This asset TVL is basically the amount of assets they have on the balance sheet. If this is super high, like really, really high, these APRs here and here are going to go down. They're going to be paying more to get TOKE. They want the TOKE coin. So I know it's a bit complex to understand. This is only built on Ethereum right now, but they are planning on going multi-chain. So that is something to keep in mind as well. And not only that, there was one tweet that Danny made. This was on Friday. basically, as sex listings expand, I've decided to hire a market maker with my personal spell tokens to be able to provide a good trading tight spread experience. I wonder what he's talking about here. I don't know. Then if you scroll down in Toke and you look, you got Bancor, Comp, Cream, Bit, Ban, Balancer, Near, Matic, Badger, Axie, Civic, Axie, Fantom, Xerix, Tribe, Curve, Alpha, Mist, Bond, YGG, Maker. You got a bunch of random coins, but then you see this one coin called Spell. Danny's coin. Yeah, so I don't know. Maybe time will tell. We'll see what happens. It's all speculation. Of course, this is not financial advice. I'm not a financial advisor. I'm just kind of explaining to you guys a couple of things on Toke. They do have their white paper that just launched, so you guys can look into it. But basically, just launched these reactors for directing liquidity. The winners, well, first Frax is the winner. Then you got Alchemix, TCR, TracerDAO. Ohm, and then you got SushiSwap. Of course, these are the runner-ups. So right now they're only doing 5. So the voting allocations are coming for Core V2. Just giving you guys the TLDR on the Toke coin. What is the use case for it? Okay, so if a project wants to launch their coin or bring liquidity to it, aka access the treasury in the vaults, they are integrating with Olympus DAO as well. So they're going to have access to their vaults. Guys, this is going to be okay, it's not financial advice, but when they reach singularity, it's going to be the black hole for liquidity. But TLDR on the coin, what is the use case for it? Well, you got project users who are like, hey, bro, we need to launch our coin. How can we do this? Oh, well, you need the Toke token. When they're providing that Toke, or aka buying it so they can have voting power, they're going to say, hey, we want this money here. We want this money here. And that's what it's going to be used for that. Now you have on the opposite side people staking and speculating and like, hey, it's going to go up in price. I love it. This protocol is awesome. Da, 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 da. You guys get the point. Earn staking rewards and so on. And next, you also have the LP providers who want to take advantage because they're like, oh, dude, there's going to be so many people buying this Toke coin because there's so many projects launching. They need Toke for being able to direct liquidity. You need the Toke coin to be able to have a vote and say, hey, your treasury of $1 billion or $2 billion, $3 billion, we want to direct it here. Can you send it here? And people will vote on it. So it's basically a DAO, and owning that coin is basically going to give you a vote for it. Now, I know you're asking yourself, you're like, what the snap? How the pants is a new project going to be able to buy this Toke coin? What the pants? It's going for like $1,000, and I got to buy 1 million of them to get a vote. Well, not 1 million, but you guys get the point. Buy a significant amount to actually get a vote. They got borrowing coming soon. So when there's borrowing, people can borrow it at 1%, 2%, whatever the rate is, and that's also the use case for the coin. Someone speculating and saying, oh, I know there's going to be a lot of demand for this. I'll buy the coin and I'll lend it out to people. So these projects can borrow the coin so they can have a vote. When they vote, they can get liquidity, da-da-da-da, you guys get the point. But being able to borrow that coin is going to add even more demand on this coin. Guys, this is just built on ETH. Let me show you guys what the chart looks like. Tokemak, I love this guy. And I'll also read to you guys the TLDR on it. But basically, this is just built on ETH. So yes, you do have a maximum supply of 100 million, and right now the circulating supply is 5.3 million. They may never reach this 100 million because they may not need to incentivize the rewards. Why do I say that? Well, the reason why I say that is because if you're having more projects providing and staking the Toke coin, they are going to be able to use that instead of having to issue more Toke coins. That's why I'm mentioning to you guys the point of singularity. Because now these coins or these LP tokens that they have inside their treasury are going to be earning them fees as well. Let me show you guys the chart. It's literally, it looks very nice. I like it. I don't typically show charts, but this one was something that was really interesting. Like you could see, yeah, there was a little bit of a sell-off here, and then it was quickly picked back up. I don't know. Time will tell. We'll see what happens with this. But with the concepts and ideas that it has, it's basically trying to be the director of liquidity, and eventually it's going to be the black hole of liquidity. Let me go ahead and show you guys a couple of things in their Medium article with the tokenomics so you can kind of see what's going on. Also, they did have this. This was kind of like a alpha leak. They're going to be having a NFT drop. I don't know. Time will tell. see what happens. Is it for stakers, holders? I don't know. We'll see. You guys can look into it and learn more about it. You can also learn about the toke rewards, cycles, etc. And also, this is one other thing to keep in mind. You have T assets. I have a feeling Danny is going to integrate these with Spell Abracadabra so you can borrow against it. But what is a T asset? Well, just like you go on Aave and you deposit like Ethereum USDC, you get AUSD or AUSDC. It's automatically accruing interest. Now, it's the same thing with Tokemak. These tokens are going to be T assets. They aren't going to be accruing interest. They're going to be paying the TOKE tokens to you, but basically it is your quote-unquote receipt for the stake. And whenever you go to issue or go back to get your Ethereum or USDC, you burn the T asset and you get your token back. So here's a quick overview of the tokenomics. I don't need to zoom in, but 30 million toke are given as reward emissions. So about 30% of them. 5 million are given to Cycle 0 Degenesis event. This is already passed. 9 million is given to the DAO reserve. 16.5 is given to contributors. They have a 12-month cliff plus 12-month linear vest. Then you got 14 million for the team. Same thing, 12-month, 12 vest. 17 million for investors and 8.5 for DAO and market makers. So basically you can say the team, investors, and early adopters are going to have about 47% of the supply, 45%. So that is a little bit concerning to me. I don't like that part about the protocol. I do like how it's a 12-month cliff and 12-month linear vest, but you guys need to listen to one of the devs and obviously the co-founder, or actually founder of this project. He really knows what he's talking about. You can kind of get a feel for the theme of their project. It's kind of goofy, but they got some tunes on here. And here's kind of like their radio tunes. It's not my gig, but I don't know. But that's what it is. Let's go and get out of this junk. But yeah, that's kind of a feel for the team. They kind of play. It's kind of fun. It's similar to like Alchemist. It kind of reminds me of that. But this is heavily involved with Olympus DAO as well. As you guys can see on one of their reactors, Olympus DAO is getting on there as well. But they got a lot of pretty big name projects. And TLDR, guys, as more and more projects integrate and put money into this, they're going to be getting a portion of those swap fees. And with more growth, there will be more demand on the TOKE token. Anyways, guys, I'll be making updated videos on what's going on with TOKE. I really like TOKE. Of course, this is not financial advice. I'm not a financial advisor. And if you guys want to hear my thoughts and different strategies on what I'm doing in the markets, there's a link to the Discord in the description below. You guys can join into that. It's the Patreon link. Yes, it is paid for. If you guys don't have enough to afford paying for the Patreon, there is a Telegram chat. You guys can chat in there, ask questions. The Telegram is more so for beginners, and the Discord is more of the advanced DeFi users. The reason why I had to do that is because we were just getting a lot of random questions. And there's nothing wrong with it, like saying, hey, how do you LP provide? How do you buy this coin? Is it on this exchange? That's more so more advanced users. They already know. They kind of just want direct information, and that's what the Discord is made for. If you know what I mean, you know what I mean. Here's chapter 17 verses 20. One whose heart is corrupt does not prosper. One whose tongue is perverse falls into trouble. Also, some other cool things that I really like about TOKE is, say for example me, I want to just deposit ETH and I don't want to have any impermanent loss. What I can do is I can deposit my Ethereum tokens and I can earn TOKE in exchange. And there's no impermanent loss. A lot of people don't like to provide liquidity because impermanent loss, yeah, it is a thing. Especially when you're farming with these coins and, well, the token, the farming coin, goes to zero and your ETH goes up to the moon and is like, what the snap? I'm like a farming millionaire. Like, as in the farming coin, you just have a ton of them. Similar to like the Titan trillionaires, if you guys know what I mean. Also, another thing that I really like about TOKE is when projects are trying to launch their protocols, all they have to do is give up their tokens. So instead of having to go outsource ETH like they do providing liquidity incentives, like, you know, the farming coins, they pay you a bunch of tokens so you can LP with their coin and some Ethereum. That is how they're outsourcing it. Now, to limit that and give less tokens up front, because the reason why it's less is because Now, when people are buying it at a lower price and they're getting paid the rewards to do it, all the protocol has to do is say, here's the tokens, do what you want to do with them, Toke, you know what to do best. And they take half the amount they normally would. So, say for example, a portion of their rewards were liquidity mining rewards were like 80% of their supply. So, I guess it would be one. And that little portion is the non supply. So, a bunch of them. And basically, they can cut that in half because they don't need all those coins to provide liquidity. Instead, all they have to do is provide a certain amount, aka the reward amount that they would be giving out, and the Tokemak protocol would automatically give the ETH, USDC, whatever the pairs that are against it, and automatically source that and send it to different pools. So it kind of takes care of that for you. That's also why I really like Tokemak, and it's kind of DeFi 3.0. So it's a win-win for everyone. It's a win-win for the protocol. It's a win, well, the protocol as in Tokemak. It's a win-win for the project, and it's a win-win for the user. They don't have an impermanent loss. They get good rewards. Tokemak earns a portion of the fees. The Tokemak holders are excited and happy, and the protocol doesn't have to give out as many token incentives, so their token is not diluted in price. And back to how it's the black hole of liquidity, those tokens or those LP tokens that they're making, those are constantly earning rewards. And if you see the protocols that they have, they're blue chip projects. They aren't just something that's like poop coin, pee coin, fart coin, I don't know, whatever coin. No, they aren't thrown in there. They're literal projects that are that have stood the test of time so far. So it's not something that's just like a piece of junk. So just a couple quick pointers, TLDR kind of wrap up type of thing. So there are many different things involved with this protocol. It is a complex project. I'm excited to see what will happen with the borrowing of the coin, and I'd like to see what happens with this protocol. If you guys have any questions, leave them in the comment in the description below, and make sure you guys look into some of the interviews and articles with the founder of Tokemak. And you guys can also get into the Discord and see what's up. Thanks for tuning in, guys. Y'all guys can also catch me on Tweeters. It's at Rent a Home Fast, like literally at Rent a Home Fast.